Most people scroll past three letters that could quietly build them hundreds of thousands of dollars. Those letters are H, S, and A. And if you're in your 20s or 30s, ignoring them might be one of the most expensive decisions you never knew you made. A health savings account isn't just a place to stash money for doctor visits. In the right hands, it's a tax-shielded investment engine. One that, started early and managed well, can compound into a six-figure nest egg by the time you actually need it most. Here's everything you need to know. Let's clear up the most common misconception first. An HSA is not just a healthcare piggy bank. Yes, it covers medical expenses. But underneath the surface, it's one of the most powerful wealth-building vehicles in the entire U.S. tax code, and most people walk right past it. To access one, you need to be enrolled in a high-deductible health plan, or HDHP. In 2026, that means a plan with at least a $1,700 deductible for individuals, or $3,400 for families. The trade-off for that higher deductible is lower monthly premiums. And embedded in that trade-off is where the real opportunity lives. Take the money you're saving on premiums, redirect it into your HSA up to the annual maximum, and let the government subsidize your investment through what's known as the triple tax advantage. No other account in the U.S. tax code does what an HSA does. A 401k gives you one tax break. A Roth IRA gives you two. An HSA gives you three, simultaneously. The phrase triple tax advantage gets thrown around a lot, but it's worth unpacking precisely because each layer compounds on the others in a way that's genuinely rare. First, your contributions are tax deductible. Every dollar you put into an HSA reduces your taxable income for that year. Unlike a Roth IRA, there are no income limits on HSA contributions, which means high earners, who typically lose access to other deductible accounts, can use this to meaningfully lower what they owe the IRS. Second, your money grows tax-free. Once funds are in the account, you can invest them in mutual funds, ETFs, stocks, or fixed income instruments, depending on what your plan offers. Dividends, capital gains, interest. None of it is taxed while it sits inside the HSA. This is the engine of long-term wealth building, and it's the feature most people don't realize exists. Third, qualified withdrawals are completely tax-free. When you use HSA funds for eligible medical expenses, doctor visits, prescriptions, dental care, vision, hearing aids, mental health services, medical equipment, and more, you pay zero tax on the withdrawal. No income tax, no penalty, zero. The money goes in pre-tax, grows tax-free, and comes out tax-free. That trifecta is extraordinarily difficult to replicate anywhere else. The range of qualified expenses is broader than most people expect. It covers deductibles, copays, and coinsurance. It covers prescription drugs and certain over-the-counter medications. It covers dental exams, vision care, glasses, contacts, hearing aids, therapy, psychiatric care, crutches, wheelchairs, blood pressure monitors, and long-term care services. It even covers qualified expenses for a spouse or dependents, even if they aren't on your own HDHP. In short, if it's legitimately medical, there's a good chance your HSA can cover it tax-free. The most important variable in any HSA story isn't how much you contribute in a given year. It's how early you start. Consider a straightforward example. You contribute $4,400 per year, roughly $367 per month, and withdraw about $1,000 annually to cover medical expenses. The remaining balance stays invested, earning an average annual return of 5%. After 35 years, that account is worth approximately $292,000. The math sounds almost too clean, but it illustrates the core principle. Time is the multiplier. Open an HSA at 25 versus 45, and you're not just getting 20 extra years of contributions. You're getting 20 extra years of compounding on compounding. Interest earning interest, gains generating more gains, all of it sheltered from taxation at every stage. For someone young and generally healthy, this is the golden window. medical bills are low, the temptation to dip into the account is minimal. The runway is long. Every dollar invested now is doing the heaviest lifting it will ever do. This is precisely why the high-deductible plan, despite sounding like a risk, often makes sense for younger and healthier people. If you rarely need medical care, the likelihood of hitting that higher deductible is low. You save on premiums, contribute the savings to the HSA, invest it, and build momentum before life gets complicated. Think of an HSA as having 3 distinct phases, each with its own strategic priority. In your 20s and 30s, the goal is simple. Plant the seed and leave it alone. Maximize contributions. Choose a solid low-cost investment option like a broad index fund, and resist the urge to treat the account as a spending account. The longer you let it compound untouched, the more powerful the outcome. If you can pay medical bills out of pocket and let the HSA grow, even better. In your 40s and 50s, the balance starts to look real. Healthcare costs may begin to creep upward, and it becomes more tempting to tap the account. But the same logic applies. If you can absorb costs elsewhere, do it. Once you turn 55, the IRS allows an additional $1,000 annual catch-up contribution. By now, the account has built serious momentum, and every year of continued growth compounds in your favor. Then comes 65, and the rules change in a significant way. At that point, the 20% penalty for non-medical withdrawals disappears entirely. From 65 onward, you can withdraw HSA funds for any reason and simply pay ordinary income tax on the amount, exactly like a traditional IRA. The account effectively becomes a bonus retirement fund. And since healthcare costs tend to rise sharply in retirement, some estimates put lifetime medical expenses for a retired couple well into 6 figures. Having a dedicated, tax-advantaged pool of money earmarked for exactly that purpose is arguably more valuable at 70 than any other time in your life. A common point of confusion is the difference between an HSA and a flexible spending account, or FSA. They sound similar. Both are pre-tax accounts for healthcare spending, but they operate very differently, and conflating them leads to leaving significant value on the table. The most important distinction is ownership. An FSA belongs to your employer. If you leave your job, you typically lose whatever unspent balance remains. An HSA, by contrast, is yours permanently. It moves with you from job to job, stays active even if you change health plans, and never expires. FSAs also operate on a strict use-it-or-lose-it basis. Unspent funds are forfeited at the end of the plan year, with limited exceptions. HSAs have no such restriction. The balance rolls over indefinitely, year after year, accumulating and compounding for as long as you hold the account. And perhaps, most critically, FSA funds cannot be invested. They sit as cash. An HSA, by contrast, can be invested in the market, which is the entire basis of the long-term wealth-building argument. For anyone who qualifies, the HSA is simply the more powerful account in almost every dimension that matters. The eligibility rules are clear and relatively simple. You qualify for an HSA if you're enrolled in a qualifying HDHP. You're not also covered by a non-HDHP plan, such as a spouse's conventional plan. You're not enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return. Notably, unlike Roth IRAs or deductible traditional IRAs, there are no income limits on HSA contributions. Whether you earn $40,000 a year or $400,000, you can contribute the same maximum amount and deduct it from your taxable income. For high earners who are otherwise phased out of other tax-advantaged accounts, this is a meaningful additional avenue. In 2026, the contribution limits are $4,400 for individual coverage and $8,750 for family coverage, with an additional $1,000 catch-up for those 55 and older. If your employer offers HSA contributions as part of your benefits package, those count toward the annual limit. But they also reduce what you personally need to contribute, making the math even more favorable. An HSA isn't complicated. It's just underused, partly because the name makes it sound like a niche medical benefit rather than what it actually is. One of the few remaining triple tax advantaged accounts available to ordinary Americans. If you're younger, if you're generally healthy, and if you have access to a qualifying high-deductible plan through your employer or on your own, the case for opening and maximizing an HSA is difficult to argue against. Lower premiums, a tax deduction today, tax-free growth for decades, tax-free withdrawals for medical costs, and at 65, a fully flexible retirement supplement. The best time to open one was the day you started working. The second best time is now. Start early, contribute consistently, invest the balance, and let time do what it does best. That's the whole strategy, and it's hiding in plain sight.